Let's jump right into this explainer. Today we're unpacking AXT Inc.'s recent 10K filing, and man, it's a wild ride. We're looking at how this company is absolutely riding the massive AI wave, while at the exact same time navigating some seriously intense global trade crosshairs. They literally sit right at the intersection of tomorrow's technology and today's geopolitical realities. It's a fascinating balancing act, and the data inside this filing tells a pretty incredible story. To make sense of AXT's complex business model, we'll follow a quick roadmap. We'll start with the AI substrate boom, then look inside AXT's China strategy. After that, we'll cover the geopolitical trade squeeze, the star market wildcard, and finally wrap up with the future of AXT. All right, Section 1, the AI substrate boom, beyond standard silicon. So we hear a lot about the cloud and AI, right? But what physical material is actually powering this AI data center boom? What actually allows those massive data centers to transmit data at lightning speed? Well, spoiler alert, standard silicon simply doesn't cut it anymore when we're talking about the absolute highest performance needs. This is where indium phosphide, or NP, enters the chat. Think of it this way. While silicon is great for your everyday chips, indium phosphide is basically the high-speed magnetic rail system needed for the absolute fastest fiber optic lasers and detectors. AXT is a materials science company that creates these alternative, highly specialized substrate wafers. Basically, when a data center needs to move an astronomical amount of AI-driven data without overheating or lagging, they rely on devices built on indium phosphide. And looking at AXT's core product lineup, you can see how they provide these highly specialized materials like NiP, gallium arsenide, and germanium for everything from satellite communications to automotive LiDAR. They're essentially supplying the foundational canvases, which measure anywhere from 1 to 8 inches in diameter, that the rest of the tech industry uses to build out modern infrastructure. Moving on to Section 2, inside AXT's China strategy, vertical integration advantages. Now, what's really interesting here is that AXT doesn't just make these high-tech substrates. Actually, a full third, 33%, of their 2025 revenue came from selling the fundamental raw materials that they also manufacture. So 67% comes from the advanced wafers, sure, but that raw material slice, that represents a massive strategic advantage. See, by partially owning these raw material joint ventures in China, AXT achieves a vertically integrated supply chain. And that gives them huge advantages in pricing, reliable supply, and sourcing lead times. They aren't just at the mercy of the open market for elements like high-purity gallium or PBN crucibles. They actually make them. They even recycle their own substrate scrap, which honestly is a phenomenal and surprising asset to have in an era of global supply chain shortages. And as a real testament to this footprint, a staggering 98% of AXT's revenue in 2025 came from outside of North America. 98%. They are heavily utilizing their China-based manufacturing hubs to serve a truly international, globally distributed client base. Which brings us to Section 3, the geopolitical trade squeeze, the two-front pressure. Looking objectively at the regulatory landscape, we see AXT caught right in the middle of a classic two-front pressure system. On one side, you've got steep U.S. tariffs, meaning importing into the U.S. became incredibly expensive, with tariffs hitting as high as 70% in 2025. And then on the other side, getting the materials out of China became heavily regulated, with China forcing permit-based export controls on critical materials like gallium. So what's the fallout? Well, these dual-sided trade frictions squeezed AXT's North American revenue down from 8% of total revenue in 2024 all the way down to roughly 2% in 2025. It really goes to show just how fast macroeconomic policies can completely reshape a company's geographic revenue streams. Just tracking this over the past year, you can see how rapidly these trade and security tensions escalated, constantly forcing AXT to adapt its logistics and compliance strategies. I mean, in literally just 1 month, from February to March 2025, they got hit with permit controls on their most advanced AI substrates from China and massive 70% tariffs from the US. And even though a Supreme Court ruling in early 2026 invalidated some tariffs, the core Section 232 and 301 tariffs are still right there in place. It's an incredibly fast-shifting environment. All right, Section 4, the star market wildcard, corporate finance contingencies. So AXT is trying to list its subsidiary Tongmei on China's star market. But this process involves multiple regulatory steps and a highly conditional investment structure. They've already done the reorganizing and they've secured the private equity backing. But right now, They're stuck navigating the complex, high-stakes waiting game of Chinese government approvals to actually list those shares. And the absolutely crucial point here is this $49 million figure. That's the amount Chinese private equity investors injected for a roughly 7% stake. But if the IPO doesn't succeed, investors can exercise their redemption rights, and that $49 million turns into a massive cash obligation for AXT. It's a calculated risk for sure, but it is a very real financial contingency just hanging over their balance sheet. You can clearly see the financial sensitivity of their operations when you look at their 2025 gross margins. They wildly fluctuated from a Q1 loss of 6.4%, swinging all the way up to a positive 22.3% by Q3. This was driven by pricing, utilization, and of course, those trade frictions we talked about. When you mix highly specialized manufacturing, shifting tariffs, export permits, and pending IPO contingencies, well, you get exactly this kind of intense margin volatility. Let's wrap things up with Section 5, the future of AXT, balancing risk and reward. AXT's China-centric model drives cost benefits, but concentrates trade, regulatory, and export control risk. This industry analyst insight perfectly summarizes the double-edged sword of AXT. They have absolute mastery of a vertically integrated low-cost supply chain, but it's entirely tethered to a highly volatile geopolitical landscape. They've built this incredibly efficient engine for producing the materials of tomorrow, but the road the engine is driving on is just full of unpredictable regulatory potholes. Which leaves us with a fascinating final question to ponder. As AI infrastructure demands these hyper-specialized materials, can global tech companies actually afford the geopolitical risks embedded in these highly concentrated supply chains? The demand for materials like indium phosphide is only going to grow as data centers become more advanced. But the cost of acquiring them? Well, it's clearly no longer just a financial calculation. It's a geopolitical one. Thanks for joining me for this explainer. I really hope it helped you better understand the complex foundations powering our high-tech world. Keep learning, keep asking questions, and I'll catch you on the next one.